Hello, hello. Once again, welcome to Mini Masterclass Thursday. I am Sam, your host, and today we're actually coming to you live from, I don't know if you can see it, Bridging the Gap conference in Denver, Colorado. I've been here all week, and I have had one of the best experiences potentially ever since my very first conference back in 2016 ever. So it was not the Bridging the Gap conference. It was my very first accounting conference. And I can't rave enough about this conference that I've been to. And it has really focused on health and wellness in the for accounting professionals. It also has some accounting related, of course, content. And then above all, the networking and the collaboration between professionals. And so what we're going to talk about today, actually, ironically, we had this session scheduled already, and then I went to this conference, and it's been a giant topic of the conference here. And I actually went to a session today with several. Was it today? I think it was yesterday. My days are all mixed up. Yesterday, I went to a session with three different really highly respected CPAs in the industry who talked all about, drumroll please, reasonable compensation. So this has been something that we started tapping into, I think it was last year, might have even been the year before at this point, because I'm realizing over the last 10 years, or I have realized that we help so many S-Corp customers that don't actually get any guidance from their tax preparer for S-Corp compliance specifically. So we're an accounting firm. We do your books. We keep your records straight. We know where to put everything. We help you understand what you're supposed to have and when you're supposed to have it. But then it's really on the business owner after that to do the things that require them or are required for compliance. And what we have found over the years is that business owners aren't doing that because it's kind of like a back burner situation. They just are like, whatever, not my problem. Or they really don't realize and understand the importance of doing these things, and or that they were even supposed to. So maybe it's a you don't know what you don't know situation. And depending on your engagement with us, maybe it's just a cleanup, maybe it's, for something a little bit different. But bottom line is all S Corps, no matter how big or small you are, have to follow the guidelines that we're going to discuss today. And if they aren't followed, can be fined, penalized, reassessed as the entity selection that you are taking as the S Corp, with additional fines and penalties and back taxes, because one of the main reasons to be an S Corp or S Corp elect is your tax advantages and strategies that you can then put into place. So the IRS can and will eventually audit, I think, everybody. We've all either been there or it's coming down, and no one can tell you when it's going to happen. The better job you're doing with your record keeping and your compliance, the least you have to worry about anything going wrong in your audit. And what we do as a firm for you, as a partner to you, is we are always looking out for your best interest as the business as a whole. So it's not just about your QuickBooks, and it's not just about your bookkeeping. It's about the other parts of the business, the compliance, the payroll, the taxes, the things that you may not even know that you're supposed to do, and then helping you through those times when you need strategy, when you need advisory, when you need other help as well. So I'm going to go through today the basics in just brief detail. We will deep dive on on this conversation in our upcoming financial literacy workshops, which I did mention in our last mini masterclass, and I can mention again here. We actually have two more, so today and one more mini masterclass before the financial literacy workshops happen. The first two are going to be virtual, and those are happening on August 21st and 22nd of this year virtually. And then the next one is actually a live in-person all-day workshop in Bozeman, Montana, and that is an 8-hour class. So 6 hours of content. You've got breaks and a lunch break in there. But that one is the real deep dive. So I highly recommend, if your finances and the growth of your business and your financial literacy and health is not where you want it to be, attending at least one of those, if not all of those, because I think you'll get little nuggets out of all of them. Now, just for full transparency, the virtual webinars, workshops are going to be the exact same both times. So it's 2 different co-presenters that I'm going to be with on those days. However, that's going to be covering the exact same content. So you don't need to take both of those necessarily, unless you just, sometimes I like to retake classes because I find that I retain things differently from each time I take it. Anyway, let's move on to our topic. So first and foremost, S-Corps can only be domestic. You cannot have international shareholders. You can also not have more than 100 shareholders in an S-Corp. So shareholders must be eligible. They have to be individuals, so another business cannot be a shareholder. You can have certain trusts and estates that are shareholders, but not a partnership, not a corporation, no non-resident aliens, and most non-US entities are not allowed to be shareholders. There's only one class of stock for an S-Corp. You cannot have other financial institutions, insurance companies, domestic international sales corporations as shareholders either. And all shareholders must consent to Form 2553 election. So that's just the election form for S-Corp, but every shareholder has to make sure that's on file for them as an officer. Then you file that form with the IRS. It takes 2 months and a half-ish to really have the full process in place, and then you're officially an S-Corp. But what that means then, really, in layman's terms, is you now are officially a separate entity from your business. As a single member LLC and as a sole proprietor, you and your business are one and the same. Your tax return is one and the same. You pay self-employment taxes based on the profit of your business as either of those 2 entities. And as an S-Corp, as soon as you take that election, you are now an employee of the business, of the corporation. It is no longer your money, your work. It is the business and then you separately. So you really have to keep that in mind. And that's one of the biggest mistakes people make, is still treating their record keeping and how they pay themselves as if they always had been doing it the way they had always been doing it, as either a sole proprietor or an LLC. You do now have to keep formal record keeping and corporate maintenance. This is the part that everybody I know, every customer I've ever had has missed, at least, is the corporate maintenance. This is actually something we do not provide. However, we happen to know wonderful, wonderful partners in the tax world and corporate compliance world that do provide these services, and would be happy to connect you to make sure that you are doing this, or this is being done for you if you're not doing it yourself. This is all stuff you can do yourself, and you should be doing either yourself or by delegating it to another professional. You must maintain your corporate formalities, which means having accurate bylaws. So when you form your corporate bylaws, you have everything dialed out about how the corporation will function, who the offices are, all of that. You have to have meeting minutes recorded in order to prove that you are transacting as if you were a corporation and not a single member LLC or a sole proprietor. Now, what if it's just you? What if there's no other officers and you're the only one making decisions for you on your corporate status? You still have to keep these minutes. Not having your corporate minutes recorded is one of the biggest things in court if you get audited that they go to look at first and foremost to prove that you are not acting as a corporation. We have a really great episode of Mini Masterclass with special guest Deanne Chase, who is a business attorney. If you go through our YouTube channel, you'll find it. And she actually talks about cases where the corporate minutes weren't being kept, and therefore the election was disallowed in the audit, and that reassessed the taxes for the whole time they had been taking the S-Corp election, which because they were piercing the corporate veil is what they call it, which means you're not acting like a corporation, therefore you don't qualify for the corporate benefits that you're receiving as such. So that's one big thing, your corporate minutes, and then your shareholder consents, as well as what they call an accountable plan. Now, this part of the corporate compliance we do offer. It's a brand new service we're bringing to you because it really fits into what we do, and it makes perfect sense for us to be able to offer this to you and provide even more support with your S-Corp election. So we'll get into that. So we don't provide bylaws and meeting minutes and shareholder consents, but we do provide two other things. Well, three really: the payroll end of it, the reasonable compensation analysis, and this accountable plan that we're talking about. So you have to also consistently use the corporate name on all legal documents and public facing materials, period. You can no longer transact under your name. You should no longer accept money under your name or any of the officers under their name. You have to transact as the business, which means if you have formerly been a sole proprietor or a single member LLC and you were doing business as your name, DBA, XYZ company, you can no longer do that. You actually have to get a new EIN, and you have to when you form your corporate documents, you will then set your name as the corporate name. There will no longer be a DBA associated with your actual name. It will just be your corporation. And then therefore, no longer should you accept. I have seen people do this, and they think because they're the only signer on the account and it's their business that they can still take payments under their name. You do not do that once you're an S-Corp or S-Corp elect. And what I mean by elect is you can still be an LLC and just take this S-Corp election, which means you're taxed as a corporation, but your entity is still really an LLC, which is for asset protection. And that is different than if you form an actual corporation that is the S-Corp, and you do not have the same asset protections as you would in an LLC. So in that case, you want to definitely talk to a tax professional who does that. We do not do entity formations either. Again, we work with amazing professionals that do, but that is not a service that we provide. All right, so from there, of course, you need to keep detailed financial records of your income, expenses, capital contributions, distributions, and payroll. So here's where we're getting into how you pay yourself differently from when you were an LLC only or a sole proprietor. You have to, so if you're taking notes, write this down, have to pay yourself on payroll the minute that you become an S-Corp or S-Corp elect. What happens if you can't afford to pay yourself? Because a lot of business owners are in a position where they really can't. They can't take the money out of their business. You have to remember you are now a separate entity from your business. It's not your money. It is your business's money. If you cannot afford to pay yourself on payroll, that's okay, as long as you do not take any distributions whatsoever. One of the benefits of being an S-Corp is that you can then take distributions as long as you have met reasonable compensation already. So you have to pay yourself a minimum by IRS standards called reasonable compensation, and we'll go over what that actually means in just a second. And after you've met that number for the whole year, you are then allowed to take distributions. Distributions are important because you do not pay the Social Security, Medicare, payroll taxes that you pay as an employer on your distributions. So it is a tax savings strategy. It allows you to not have to pay those extra taxes on that money. So it saves you in tax dollars. Now, you also have to have basis in order to take the distributions, and that's something that your tax preparer would know and have information on based on how you set up your shareholders. So that's another situation you have to be aware of, which is why we highly, highly, highly recommend tax planning a minimum of once a year during or at the end of third quarter, so that going into fourth quarter, you have time to make some pivots and some adjustments. Because trust me, if you find out in December that you have to cut yourself a payroll check for the $30,000 in payroll that you didn't take because you took it all out in distributions, that's a big chunk to have to come up with at once. And if you don't have it, you're out of compliance with your S-Corp. It's a bad thing. You don't want to do that. And now tax preparers are actually being held accountable, finally, for filing tax returns that don't have reasonable compensation met, which means they may say no altogether. I can't do your tax return because you don't have this compliance in place, or they're going to require you to do it anyway to file your taxes. So either way, you're going to have to come up with the money. So do yourself a favor, start early enough in the year. I suggest early third quarter at least. And actually what I suggest is twice a year. That's really what I suggest. Maybe end of first quarter and beginning to middle of third quarter for your tax planning. But your tax preparer can then make adjustments. We can make adjustments to payroll. We can sometimes you can pay yourself less and then still take your distributions and get that tax savings. Now, you also don't pay self-employment tax on your profits as an S-Corp owner. So you're saving a lot of money in taxes by doing this, but you've got to follow the specific compliance around doing so. So your distributions and your payroll, you've got to keep all of that recorded properly. So it's no longer just, oh, throw it in this account, or oh, throw it in that account. It's a lot stricter when you are an S-Corp, because again, it's as if you were stealing money, if you think about it that way, from another business. Once you become an S-Corp, you are a separate entity from the business. It's not your money anymore. It's the business's money. So if you're just using things willy-nilly and cross-spending and putting your personal stuff through your business account, it is if you're stealing from the business. That's how the IRS would look at it in an audit, and you don't want to do that. Stealing is never good, ever, even from yourself. Not good. So that's that. Now, the tax requirements require you to also file a separate tax return, which is considered the corporate tax return, which produces a K-1, which is essentially your money that you made in profit on the business and how you will be taxed on it. Now, that goes to your personal tax return, which means your business tax return has to be done first to meet the deadline for your personal. So the business deadline is March 15th. Personal deadline is April 15th. Now, if you can't do your business return because you're not ready, then you can't do the personal return until the business return is ready. So you may have to extend both. Therefore, the extension deadline is either September 15th or October 15th, depending on if it's your business or your personal. So you do have to do two separate tax returns. So there's a lot of things to take into consideration when you are considering converting from an LLC to an S-Corp or S-Corp elect. Doesn't make sense. By the time you pay for a second return, by the time you pay your payroll taxes, are you saving money is really what your strategy should look like. And you can talk to a tax preparer about that. We actually do have a test where we can sit down and we can ask you the specific questions to help you understand what the differences will be in total costs, because you may need to get a business attorney involved to create your corporate bylaws. You may need to have extra expenses that if you're going to delegate some of this other work, there's going to be set up for your new QBO, your new EIN, who's handling that, who's enrolling you in payroll, who's starting those state agency logins for you. If you're not doing all this for yourself, those are expenses you're going to have to incur to do all of this. So we can sit down, we can map it all out for you, and then you understand really if it's worth it for you at this time. Because sometimes the answer might be no. It's not worth it enough for you to do it, or not worth it at all for you to do it now. But now you know what it's going to look like in the future. And when the time arises that it does become appropriate, you know exactly what to do. So your K1 will be for each shareholder reporting on their share of the income from the business. Again, necessity for good record keeping is imperative here because this affects multiple potential people. Deductions, credits, all of that. You also have to do a shareholder basis and limitations per shareholder as well. And then your reasonable compensation. So reasonable compensation is actually an IRS test that is about your role in the business. And to put it as simply as possible, your reasonable compensation should equal what it would take you to hire someone off the street to do exactly what you do in your business. Now, most business owners are doing everything. They're doing the janitorial work. They're doing the bookkeeping a lot of the times. They're doing the admin. They're doing the sales. They're doing the actual customer work. They're making the thing. They're standing at the register, cashing people out. They're doing everything. I don't think that there's very many times in any business owner's life that they could really get someone off the street to replace and do what they do. Nobody would want to do that. I mean, they'd be crazy to want that job, right? We as business owners are the crazy ones that want that job. But when you have employees, they don't want all the hats. They want their specific hat. So what this would have to look like is you would have to delegate the parts that you're doing to different people. What would that cost you to actually hire you? I want you to take a look. I'm going to actually share my screen. I want you to take a look at the IRS test for reasonable compensation so that you understand that this isn't just a number we come up with arbitrarily. This isn't just a 60-40 on the profit split. This isn't just a, oh, I work 10% in my business, so just pay me 10%. This isn't anything different than what the IRS wants exactly to prove that you're paying yourself the right amount in an audit. So I'm going to share my screen here. First, I have to do this. And I'm going to show you. This is what we would go through in a real life scenario to understand and come up with your reasonable compensation. These are all of the different things you would do in your business. So the janitorial work, the maintenance work, the groundskeeping, grounds and caretaker work, the office work, the market research, the sales, the retail, cashiering, clerk, bookkeeper, payroll, billing, collections, budgets, accounting, database, network, computer or IT specialists, human resources, training and development, purchasing, shipping, wholesale, supervisor of retail workers, supervisor of non-retail, clerical, management, sales managers, business officer, general operations manager, chief executive. These are all the different things that a business owner could potentially be doing in their business. Now, not only does it ask what of these do you do, but then it asks the time, the percentage of time you spend doing that thing. Do you spend 2% of your time doing that, 5% of your time, 10% of your time? You may have to really sit down and think about this because whoever is very aware of, oh, I'm spending 10% of my time doing this. Hardly anybody. Then it also wants to know the proficiency of that thing that you do, that you have. This is all in order to understand what it would take by industry, by geographic location, and by role, what you would have to reasonably pay someone else to do all the things you're doing. Because if your proficiency is low, then really you're not going to be paying somebody a high wage to replace you in that proficiency in that thing. You'll probably be able to pay them a lower wage than if the proficiency was very high in that category, because you would want somebody knowledgeable, educated, and experienced in that role, in that task. So this is the IRS compliant reasonable compensation questionnaire that we go through with you in determining what your reasonable compensation would be. After that's determined, you then would make adjustments to how you're paying yourself. You would pay yourself that amount. Let's just say that amount comes out to $100,000. And you're like, there's no way I can take $100,000 salary a year. I can't do it. Well, again, you don't have to take it, but you cannot take distributions. You can't decide, which is what this is doing, that I'm just not going to pay myself on payroll because I don't want to pay the payroll taxes. I'm just going to pull money out of my account like I'm used to doing all the time. That's called a distribution, just taking the money out of your account. You cannot take distributions if you haven't met reasonable compensation. And I can tell you, many customers last year in fourth quarter, we had to turn their distributions into payroll so that they met reasonable by the end of December 31st and they were not out of compliance. In a couple of those cases, that tax bill was in the tens of and twenties of thousands of dollars that they had to come up with. Yes, they had the cash for it because they were, if you're taking that kind of distributions, you probably have a little more cash in the bank. But who wants a $20,000 hit at the end of the year when you could be paying yourself and it comes out little by little all throughout the year? One of our very favorite tax preparers that we work with, her mindset, and I love this too, is that your taxes should be paid in full through payroll for the year so that by the time you do your tax return, you owe nothing to the IRS for your personal. And you can strategize and you can make things like that happen so that there is no chunks. Additionally, once you owe $1,000 or more in any tax year in taxes, you have to, at that point, then pay estimated quarterly taxes the next year. But if you are paying yourself all year long through payroll, you don't have to make those quarterly tax payments because you're already paying in little by little by little. So again, instead of coming up with these larger chunks that you might pay out quarterly at this point in hopes that you're paying enough, you're actually paying it all through payroll and not having to worry about those chunks. So that's reasonable compensation. Once that is met, then you can take your distributions, then you save that tax on the tax side of things. And that's where the S-Corp benefits really start coming in. Some states also charge a state compliance fee or tax. In California, it's 1.5% or a minimum of $1,800 or $800 a year that you have to pay just for being a corporation. And in New York, it's 8.85, if you can believe that. And local jurisdictions like Philadelphia and Wilmington may have additional local taxes. So you also have to be prepared to pay more fees and more taxes. Again, does this make sense for your business and for you in what you're going to save in the long run per state? So again, who's looking out for that for you? Who knows that? Do you know that? Do you know how to research that? Are you a remote employer who has employees in a different state, and them working in that state creates what they call a nexus in the state, which now means you have to pay a corporate tax for transacting in that state? Who's looking out for you for that? Do you know that information? Do you know who to ask that information? That's all part of services that we provide, and we can help you manage on the corporate compliance side of things. The tax return itself that for corporations is the 1120S. And then we already went through the deadlines, which is March 15th and September 15th. So that is all the S-Corp compliance. And most of the time when people are, in my experience, when people are converting to S-Corps or just taking the election up front because they don't even know any different, or somebody just did it for them that way, they don't realize that all these things go into play. They think, oh, I just get to take my distributions, not pay the payroll taxes, save money, and not have to do anything. And that is so wrong. And the IRS has really made it clear that compliance is a big issue for them, and that they do intend on enforcing it. And like I said at the beginning, I'm in circles with lots of CPAs and tax preparers who are really starting to understand how seriously this needs to be taken, and they're not filing their returns if the corporation hasn't met compliance, because it's actually on them now too. They can get fined. So I want you to understand all the things that you need to understand for your business. So once you take the election, you have to have every officer has to have their paperwork, or shareholder has to have their paperwork in order. You have to keep separate books you have to change everything. It's a new EIN, it's a new everything. Your record keeping has to be correct and accurate, and no more cross spending, no more personal transactions. Everything's in the corporation's name, period. No more transacting under anybody's regular name. You have to file a separate tax return. You have to understand if you have nexus in a state that you may be hiring a report. You may be hiring in remotely, excuse me, which then creates the corporate taxes in your own state and and potentially in a different state for having a remote employee. You have to have basis in order to take distributions. You have to have met reasonable compensation in order to take distributions, or you cannot. And I know people say, well, how am I supposed to live if I can't take my distributions? You pay yourself through payroll. So whatever you were going to take out in a distribution, you take out by paying yourself through payroll. Well, but then I don't make as much because I have to pay payroll taxes. Yes, just like you would have had to pay taxes on your profit, on your bottom line, when you take money from your business, you are spending its profit. That's how that works. You don't pay the 15% self-employment tax at all. You just pay your regular income taxes that you would have to pay anyway as a normal sole proprietor or single member LLC. And then you have to have also what they call an accountable plan and your bylaws and your minutes and that compliance. If you're going to spend your personal money on business related transactions, or if you want to be reimbursed and or compensated for your personal expenditures on behalf of your business, so mileage, cell phone, if you pay your health insurance out of your personal account and you want the business to absorb that, if you have any kind of home office deductions that you can take, you have to set up what they call an accountable plan for your corporation that details out every single thing that you may spend your own money on, and then gives the corporation permission to reimburse you, because remember, now you're a separate entity. So it's just like you were a normal employee that didn't own the business, that wasn't the business owner. It has to be in writing and documented that you can do that. And then there has to be a process documented. And then it has to be shown and proven that you followed that process. That's part of the bylaws and the compliance part of it. I don't know anybody that's ever done that upfront. That's always because behind the scenes, somebody's going, hey, you're reimbursing yourself, but where's your accountable plan? Now, the accountable plan needs to be updated and kept current all year long, every year. And so does the reasonable compensation, because everything ebbs and flows. Geographical by location, you might have wages go up, wages go down. You may be doing something different in your business now, which means you have to pay yourself differently, because it always has to represent what would be reasonable to somebody walking in off the street. These are things that have to be done annually. It's not a one-time set it and forget it. Your minutes have to be updated. All of that stuff has to happen all the time. It's constant upkeep. So that being said, we are now offering an S-Corp compliance package. It is an annual package. It covers your reasonable compensation. It covers your accountable plan. It covers quarterly reviews of the information and of your corporate compliance, and 2 tax planning strategy meetings a year that are all included, so we can make sure that we're always doing what's best and what's most advantageous for the corporation, because there could be strategies that you don't know that exist that you can put into place because of your S-Corp election. And we want to know about those things up front and not reactively when maybe there's nothing else we could do about it. So all of that is included in the S-Corp compliance package. We're going to put all that detail and information in this episode directions or instructions so you can see them. And you do not have to be our regular bookkeeping customer in order for us to do your S-Corp compliance package. We just need access to the information, and we need, of course, access to you so that we can see and go through the steps necessary and book those calls out as necessary. So I hope this was helpful. If this is all Greek to you and you're like, what the heck is she even saying? I had no idea about any of this. It's okay. You've got to start somewhere. Reach out to us. If you're doing some of the things, but not all of the things, now you know what you need to know in order to be completely compliant. If you're still an LLC or a single member or, excuse me, a sole proprietor, and you're thinking, let me see if this is beneficial to me to convert, reach out. We can do, like I said, an analysis for you to help you understand the big picture, what you'll save, what it's going to cost you. Just like anything, there are upfront expenses to doing any of this. And that's just part of owning a business. And those are all write-offs. And part of the great thing about being an S Corp is that you can take your payroll as a write-off. It reduces your net taxable liability as a corporation, which before you were paying 15% self-employment tax on all the money you were taking out of your business, but you've got to do it all right? So we want to make sure that you are, whether you're our customer bookkeeping or not, we can help you on this end. If you are looking for a new tax preparer that's going to look out for all of these things for you, we have several recommendations we can give you. And of course, as always, if you need somebody to help you manage and run your business and look out after your financial health and wealth, we do that too. So thanks everybody for joining us on Mini Masterclass Thursday. We'll put resources and links in here for you, and we will see you again in 2 weeks. We hope everybody has a lovely weekend. And again, signing off from Denver, Colorado at the Bridging the Gap conference. See you all later. Bye.